I wanted to prepare this presentation for anybody looking to start trading Forex. There's many different routes when you start trading Forex, whether you have to pay for a course, pay for a mentorship, or pay somebody to learn the education of what you need to know to become profitable. And that's why I actually put together this presentation, because I want to set realistic expectations of what it actually takes to become profitable in the foreign exchange market. And I think this crash course will give you a very good, logical, step-by-step process of how you could approach the foreign exchange market. So we're going to start off starting with the basics of Forex, what Forex is, and basic terminology. And then we're going to go through all the different types of analysis and the psychological aspect and how you should treat Forex like a business. Like I said, if you have any questions, concerns, comments, make sure to drop them right in that chat. I'm looking at it all the time throughout this whole entire presentation. And like I said, I may not get to it right then and there, but I will finish up my thought and I will try to address any questions or concerns that you guys may have. So we're going to start off with the basics of Forex, just going into the basic terminology and what Forex even is. So we're going to start off with Forex basics, and there's 4 different pillars of Forex, starting with technical analysis. My approach to trading is a technical based approach, and we'll go into what technical analysis is, what fundamental analysis, the psychological aspect of trading, and how you should treat Forex like a business. Most people leave this one neglected. They only focus on technical, fundamental, and psychological. They leave the business aspect completely neglected, and we're going to make sure to go in depth in this exact aspect in this webinar. So first things first. What is Forex? Everyone thinks it's a pyramid scheme, a multi-level marketing scheme. They think that you have to refer people onto a platform and that's how you get compensated. That's not what Forex is, okay? And we're going to make sure to set that straight today. The foreign exchange market, or Forex, is a global decentralized financial market that allows anyone to trade national currencies. It involves buying one currency and simultaneously selling the other. This Forex is traded 24 hours a day, 5 days a week by banks, institutions, and individual traders worldwide. Now, it's so funny because so many people, like I said, associate Forex with a pyramid scheme or a multi-level marketing scheme. But when you tell somebody that you trade stocks or something like that, they don't have the same predeceived notion. And that's because iMarkets Live, or IML, actually focuses on referring people onto a platform, and they say that they're going to teach you Forex. The problem is that this gave Forex a very bad name, and now everyone always writes Forex off thinking that it's just a pyramid scheme. And that's why I'm here to educate the masses of what Forex actually is. So now let's go into the common comparison of Forex versus stocks. Now, just basically going into what they trade. Forex trades global currencies, right? Like Great British Pound, US dollar, Japanese yen, any of those types of currencies that most nations use on a day-to-day basis. But the stock market, you're trading shares into a company. So you're looking things at earnings report and how well the company is performing. With Forex, you're looking at a nation's economy. So a little bit different of the market which you're trading, but at the end of the day, they're still both financial markets. Forex markets are open 24 hours a day, 5 days a week. The stocks are only open during opening hours, right? Limited to opening hours. And this is very good for people who have a lot of priorities, whether you work a 9 to 5, whether you have kids, whether you go to school, you go to college, whatever it may be. I always tell people that it's much easier to trade Forex because it's open 24 hours a day rather than having to only have to deal with the stock market, which is usually a 9 to 5. So if you miss the opening hours, there's no way that you could trade the stock market. But with Forex, you could trade after your work, before your work, while you're in work, right? So there's much more opportunity to trade the foreign exchange market than there is the stock market, just because not only is there more activity, which we'll get to next, it's open for a longer period of time. We're getting into much more liquid markets, and the stocks are not as liquid. And what do I mean by liquid? Do I mean like they pour water into the markets? No, that's not what I'm talking about. I'm talking about the activity in the markets. We're talking the foreign exchange market is the most liquid market in the world, and it's not even close. It's not even close. You can see the depiction at the bottom. $5 trillion per day, the average trading volume. And then the next biggest is the New York Stock Exchange at $22.4 billion. So, I mean, you're talking about near $50 million every minute getting traded on the foreign exchange market. So there's no activity like the foreign exchange market, and this allows for more trading opportunities and way more opportunity in the markets. Next is the leverage, the access to leverage. Forex brokers provide way higher leverage than stockbrokers do. And this is a very good perk for regular retail traders because it means that you don't have to put as much capital up front. Leverage, and we'll get into this terminology down into the presentation, but it basically says how much your broker is going to multiply your investment buy. So let's say I have an investment of, I'm investing into a broker and I'm only investing $50 into that broker. Well, if I have 100 to 1 leverage, that means that I could trade up to $5,000 worth of capital, right? Or $50,000, excuse me, my math isn't the best. $50,000 worth of capital, because you're going to multiply that initial $500 and then you're going to multiply that by 100, right? With the stock market, they have very low leverage. So this means that you can't really multiply your initial investment by much because stockbrokers do not provide high leverage. And this is the exact reason why you could actually flip $25 to $2,000 in Forex. And I highly recommend you not doing that if you're not experienced. But you could have access to this higher leverage. And then Forex, there's lower market manipulation. In the stock market, there's higher market manipulation. This is basically because it's very easy for companies to manipulate their earnings reports, just because it's much easier for shareholders to come together and sort of agree upon a certain price. With Forex, it's not like that, just because there's so much activity. Even though there's like 5, 6, 8 big banks that control most of the market, there's so much activity going on in the foreign exchange market that it's so much harder to manipulate it than it is the stock market. So I thought it was important to note that. So let's go into the next presentation, which is... So now we're going to go into important terms, and I'm going to go through these very quickly, just because I know a lot of you probably already know this basic terminology, and I don't want to bore you with all of these different things. So first things first is a currency pair. You should know in the foreign exchange market, we're trading currency pairs. Just like the stock market, you trade companies, we trade currency pairs. Trading Forex involves buying one currency and simultaneously selling another. You cannot trade only one currency, and this is a common misconception. Whenever I say I trade Forex, national currencies, everyone's like, oh, so you trade the US dollar. Oh, so how's the British pound doing? And that is a common misconception. These currencies are traded in pairs. So the only way to trade Forex is by trading them in currency pairs, meaning each pair includes a base and a quote currency. So let's look at the different types of currencies. So the major currency pairs are every single currency pair that includes the US dollar. And I highly recommend, if you're a new trader, to only look at major currency pairs. The reason being is because the US dollar is the global reserve currency of the world. So this means that many investors are going to be looking at major currency pairs to invest in. There's a lot of activity in major currency pairs. The spreads are razor thin, and this means that you'll be able to get a better entry price of where current market price is currently at. So that's why it's much more important to focus on major currency pairs, and they're way more stable than any other currency pairs. You do not want to be looking at exotic currency pairs if you're a new trader. Maybe some of the minors you want to get used to, but the major currency pairs are very good for new and aspiring traders. Next, we're going into the minors, and these are frequently traded currencies that do not include the US dollar in the pairing. So we could look at NZD Canadian dollar, Euro Canadian dollar. Anything besides US dollar that's not an exotic market is considered a minor. So GBP JPY, GBP Canadian dollar, anything of that nature. And then the last we have is the exotic. So these are things that you don't hear off the top of your head, like Mexican peso, a lot of different exotic currencies that could be traded, but I highly recommend, if you're not a new trader, to not trade the exotics at all, just because they're an absolute nightmare to try and trade. The spreads are so large, meaning you could easily get stopped out of your trades, and they're not as predictable when it comes to technical and fundamental analysis. So I would highly recommend you only focusing on major currency pairs. But like I said, we could only trade Forex if we're trading them in currency pairs. The first currency is considered the base currency, and the second currency is considered the quote currency. So we can see on the example right here, we have Euro USD. And by the way, Euro USD is the most active currency pair that's traded throughout Forex. I think near 30 to 33% of the Forex transactions happen on Euro USD. So we can see the base currency. If we said that we were going to sell Euro USD, right? That would mean that we want Euro to drop and we want US dollar to rise. But let's say we were going to buy Euro USD. This would mean that we would want the Euro to rise and the US dollar to fall. Okay, so we could see pretty much right here. If we're selling Euro and buying US dollar, and then buying Euro and selling US dollar. So everything that you're doing is just opposite of each other. If we're selling this means we want Euro to drop and we want USD to rise. Pretty much exactly what I just said. So this is the basic of currency pairs, just going over how we actually trade the markets in Forex. It's in currency pairs. Next thing we have to look at is leverage, basically what I was trying to say before. So leverage enables Forex traders to borrow a certain amount of money that allows them to trade in much bigger deals, allows anyone to trade using more than they have in their account balance. So if you want to trade $1,000 in the foreign exchange market, you don't have to put up $1,000, right? Depending on the leverage, you could only have to put up $10 to $100. So it's pretty much just borrowed capital from other brokers. The money is borrowed from a broker who acts like a bank that fronts you some cash to invest in, which in this case is to buy currency. So let's say we're opening a Forex account and we're looking to trade Forex, right? And we start off with 100 to 1 leverage, okay? And we invest $1,000 in that account balance. This means that we have up to $100,000 worth of capital to trade with in the foreign exchange market, just off of our $1,000 investment, right? Because remember, they're multiplying our capital invested by 100 if it is 100 to 1 leverage. Now, it's very important because a lot of people always ask, what's the ideal leverage? Well, it depends on your trading system or your financial goals. If you are trying small, like high risk, high reward strategy, meaning you're investing $1,000 to try to make $10,000, you're going to need high leverage, just because this means that you won't need as much capital to put up front for a trade, especially if you don't have much capital. So let's say you have $1,000 and you're trying to flip it to $10,000, you're going to need 100 to 1 or 200 to 1 leverage, just because you won't need to put as much capital down for that trade. But let's say you want small wins, like small consistent wins. You only really need 50 to 1 leverage or even 25 to 1 leverage, just because you're only risking around 1 to 2% of your account balance. So you won't need much capital to actually trade if you're going to be trading small consistently. So I highly recommend, if you're a new trader, just start off with 50 to 1, something very easy. And you don't need a ridiculous amount of leverage to actually trade the market small and consistently. So this is the idea of leverage. And again, guys, I do have the chat open. So make sure if you do have questions, concerns, comments, please blow up that chat. I would love to be able to answer anything you guys may have. We're going to dive into the next part of this, just because I think leverage is pretty self-explanatory. We're going to dive into a pip. What the hell is a pip? And if you don't know what a pip is, you could just leave right now. No, I'm kidding to you. So a pip is a price interest point, and this is the unit of measurement to express the change in a value between two currencies. So a pip is the smallest price move that an exchange rate can make. So this is basically a unit of measurement that all Forex traders use to measure their profit or loss within a trade. So most pairs go out to 4 decimal places, but there are some exceptions, like Japanese yen pairs that go out to only 2 decimal places. So we can see on the right-hand side right here on Euro USD, this is the exchange rate, right? This would be considered the exchange rate. So this means 1.11500. So this pretty much means that in order to get a euro, you have to spend 1.11500 US dollars to get a euro, right? So if we just move the decimal 4 times, 1, 2, 3, 4, this is considered a pip. Okay, that's the easiest way to consider something a pip, is you move the decimal places 4 times, and then that's how many pips prices actually moved. But with Japanese pairs, so GBP, JPY, NZD, JPY, anything JPY, you only move the decimal place 2 times. So this is basically one of the smallest movements that price could move. And we will talk about, I think if it's not in this presentation, I talk about it a lot with my premium members, and sort of just in general, we talk about pipettes. And that's actually smaller than a pip. And that's actually this decimal point right here. That would be 5 decimal places. But basically 1 pip is a small move that a exchange rate could move. That's it. So now that we have a better idea of what a pip is, let's get into some more terminology, just because the terminology is so fun, right? Now we're going to be talking about margin, I believe. So margin is very important. Oh, excuse me, lot size. We're going to get to margin, don't worry. So lot size is very important. This is defined as the position size you take in the market that determines the size of your profits and losses in dollar value by affecting the value of a single pip. So your lot size is basically the severity of how much your position is in the markets. So if you're starting off at a standard lot, which is one of the most or the highest lot sizes in the market, that means that you have a lot of capital on the line. So if you do 1.0 lot size, this means that it's $10 per pip. Now, let's say you only want to do 0.10 lot size. This is $1 per pip. So every single pip that rises or falls accounts for $1. Okay, so this is basically putting a monetary value to every single pip that rises or falls within the market. In the Forex market, one standard lot equals 100,000 units of the base currency. For example, if you take one standard lot in a Euro USD pair, you're actually trading 100,000 euros with a pip value equal to $10. We're not gonna, that seems a little bit confusing. Let's break it down to beginner terms, right? Let's say you are trying to trade Euro USD, okay? And you have a 10 pip take profit. A 10 pip take profit, right? And we just talked about pips before, so you should know exactly what pips are. Let's say you want price to move 10 pips towards the upside, and then you take out of that trade. What would you make? $10 if you had a mini lot size. So if you want to make $10 on a trade with 10 pips, you would place a 0.1 lot size because this is $1 per pip and you're targeting 10 pips, right? So that would be a $10 take profit. That would be 10 pips. So you need to place your lot size based on how much you want price to move per pip. Sometimes you're going to place a 1.0 lot size, and that would say $10 per pip. So you're able to effectively leverage your account balance by using a position size calculator, and we're going to get into this later in the presentation of what resources you could utilize to actually leverage a position size calculator. If you're not using a position size calculator before every single trade, you are leveraging your account incorrectly. You need to utilize a position size calculator before every single trade you place in and out of the markets before you're actually trading the markets, because you won't know this off of the back of your head. You won't know this just by calculating it in your head. You need to use a calculator for every single trade that you place in the markets. If you don't, you're gambling. Without a doubt, you are gambling. So we're gonna get into that. So that is a lot size. Now we're gonna go into spread. Spread is very important. So spread refers to the difference between the bid and the ask price. There are always two prices given in a currency pair, the bid and the ask price. So you'll see on the right-hand side, whenever you're trying to trade a currency pair, let's say Euro USD, I know Euro USD is very popular. As you can see, I've used it like 3 or 4 times already. But we can see Euro USD on this side right here. It will give us the sell and the buy price, right? So if we want to sell Euro USD, this is the price that's given. And if we want to buy Euro USD, this is the price that's given. Now, if we subtract both of these numbers, this would be our spread. The 2 pips would be our spread. Now, there are times in the market, usually market intercession or market interchange, where the spread will rise and it will fall, right? We want the spread as razor thin as possible, just because this gives us a better market price. This gives us a better execution price of where market price is. So brokers quote the bid and ask price for different currency pairs. So with major currency pairs, the spread is going to be much, much lower than exotics or even some minor pairs. Remember, we want the spread to be as low as possible because that gives retail traders a better execution price of where you want to enter or exit the market. So make sure in the back of your head, you want the spreads really low, just because if they're ridiculously high, not only will you get executed at a bad price, but a lot of times you may end up getting stopped out, even though price doesn't end up going there, just because the spread is ridiculously wide. And that will happen a lot of times. Brokers will raise the spread just because they want to stop you out, and that will happen. All leverage trading providers will incorporate a spread into the cost of placing a trade as they factor in high ask price relative to the bid price. The size of the spread can be influenced by different factors, such as which currency pair you are trading and how volatile it is, the size of your trade, and which broker you are using. The spread is measured in pips. So it's very important to get a good idea of what your spread, what broker you're using and what spread they're utilizing. If their spreads are astronomical, like 10 plus pips on every single currency pair, you should not be trading with that broker, because that most likely means that they're manipulating the market and they do have some skin in the game. So now we're going to go into margin. This sort of goes hand in hand with leverage. When trading on leverage, your broker will allocate a portion of your trading account size as the collateral for the leverage trade. This collateral is called margin, and its size depends on the leverage ratio that you're trading on. A leverage ratio of 100 to 1 asks for a margin that equals 1% of your position size. So let's look on the right-hand side here. So we can see if we're trading 1-to-1 leverage, meaning no broker's ever actually leveraging our account, that means we would have to have $100,000 to actually trade $100,000, and that makes sense, right? Because they're not leveraging our account. But if we had 2-to-1 leverage, that means we would need to have $50,000 in our account balance. The margin is basically just the amount that we need to invest to actually execute the trade. So remember, if we had 100-to-1 leverage, in order to trade $100,000 worth of a trade, we would need $1,000 in our account balance. Okay, so you could see how margin and leverage go hand in hand with each other. It's basically your margin is the amount that you need to invest in your account balance. You need to have it in your account balance. They almost use it as collateral, and that says it right here. They use it as collateral for the leverage trade. So it's basically saying, okay, I'm a Forex broker. I need your $1,000 in order to place you into this $100,000 trade. That's basically what they're saying. They need something. They need an investment for you to place into a bigger trade. So it's basically just being used as collateral. So there will be a lot of times where you will get margin called, and that is only if you're blowing the account. But this is basically just saying that you need to invest more capital into the account. So now that we're pretty much done with the basic terminology, now we're going to get into the good stuff. Now we're going to get into the different or we're going to get into the basics of a trading system. And I usually go through this with my premium members, but we're just going to go through the basics of a trading system, what it absolutely needs. So first things first, what markets are you trading? Are you trading crypto? Are you trading commodities? Are you trading options? Are you trading Forex? Are you trading stocks? Make sure you're identifying the markets that you're trading. The second is your trading thesis. If you're not able to identify your trading system in 1 or 2 sentences, you don't even know your trading system. So it's very important to get a better idea of how you trade the markets. Force yourself. If I asked you, how do you trade the markets? And you're saying to yourself, I focus on this indicator and I usually place when moving averages cross here. And yeah, it usually you need to be very clear with your trading system. Example for me, I trade bounces off of daily horizontal levels. That's all I do. I go on the daily time frame, I outline support and resistance levels, then I scope down to the hourly time frame and I monitor the price action on the hourly time frame, whether it's bearish or bullish, around these significant support or resistance levels. So make sure that you have an overall trading thesis of what you are trading in the markets. 3, what are the market conditions? Does your trading system work in all market conditions? Does it work in trending and ranging markets? Because there are some trading systems that only work in ranging markets, and then there's some that only work in ranging markets, or trending markets. So make sure that your trading system works in both different types of market conditions. 4, what type of indicators do you use? If you do use indicators, make sure to put them in this section. And then 5, entry. Make sure that you're identifying all the pieces of criteria that actually outline an entry. This is big for a lot of people because they just think of it in the back of their head and they're like, oh, it looks good. Once you have it on a document or some type of paper, it gives you a better idea, and you become way more objective when you're placing your trades. It's very important to write down the exact entry criteria that you need before you're actually entering the markets. 6, your stop. So where your stop loss would be, where your take profit would be, and how you manage the trade, right? Maybe your stop loss is below it or above an invalidation zone. Maybe your take profit is at a previous structural low or high, whatever it may be. 7, what is your risk management practices? Are you risking 1% to 2% per trade? Is it dynamic? Do you have a trailing stop loss? What's the deal with that? And 8, other important rules. So anything that you think is worth noting in the system, make sure to note it there. Now let's dive into the fun part, technical analysis. And as a technical trader, I want to be able to spend a good amount of time actually understanding the basics of technical analysis. And again, this is just scratching the surface. You could ask my premium members, which a couple of them are here today. Shout out to Vic and Angel. Thank you so much for hopping in. You could ask them. I mean, I go way more into technical analysis than I do fundamental analysis. So there's a lot of technical things that I'm not going to go over today just because it's more expertise going through my YouTube channel, going through daily market lives like that. You'll sort of be able to get a better idea of technical analysis than this presentation, but this is just scratching the surface, right? The more lessons that you're going to get is actually doing rather than me teaching you. And that's what I'm always advocating for. I'm always advocating that you do instead of try to learn so much. Even though education's phenomenal, you have to remember education is not the denominator of what makes you profitable in these markets. It's execution. It's you marking up the charts on your own. It's you marking up support and resistance and then failing and then losing a trade, blowing an account. That's way better of a teacher than me trying to teach you everything and you going onto the charts could ever be. You failing, learning, and then repeating is a way more valuable cycle than you just trying to learn everything you can and then marking up the charts. Let's get into it. Technical analysis basics. Technical analysis is what you perform on the charts to give you a certain direction of movement, of market movement, to then allow you to look for an opportunity. Never forget the basics. The basic principles in Forex are the most important. One of the most important things you should learn about the markets is the overall flow of the markets. Let's take a look at how it generally flows. And I want to, before we actually jump into market structure, price action, and support and resistance, there's one thing I want to note. Because I said it, never forget the basics. I say this on my lives a lot of times. I pretty much say that with technical analysis, trading is very similar to the education system in the United States, at least. The education system in the United States, you learn everything you need to know for on a day-to-day basis for life in pretty much elementary and middle school. You learn addition, subtraction, multiplication, division, all of the stuff that you need to know on a day-to-day basis in life today. Once you go to high school and then college, it's way more concentrated, right? You got geology, you got physics, you got chemistry, you got all these different subjects that you don't actually use on a day-to-day basis. It's no different with technical analysis. You could learn so much about trading, whether it be order flow, liquidity block, institutional trading strategy. All I focus on is market structure and price action, because those are the basic tenets of how to mark up charts. And that's all you need to trade the foreign exchange markets successfully. If anybody tells you differently, that you need to purchase their indicator, you need to purchase their course, you need to purchase their mentorship, you need to mark up the charts like this, they're lying to you. They're lying to you. People are obsessed to say, no, don't do this, don't do this. The truth is, millions of different things work in the market. It's just about what works best for you. Let's jump into market structure. So again, this is just scratching the surface, but there are three different types of trends. You have your uptrend, downtrend, and your sideways trend. Your uptrend is made up of higher highs and higher lows. Your sideways trend is no clear higher highs or higher lows, sort of the top portion of this trend. And then our downtrend is made up of lower highs and lower lows. And again, this is very, very basic. The only thing that I want you to get away from this actual slide is the fact that the market moves in three different types of trends: uptrend, sideways trend, or a ranging market, and then a downtrend. And it's very important to note that we do not create a new higher high until we wipe out the previous higher high. We could sort of see this right here, and I want to zoom in really quickly. We could see that we have a low. Price put in a new higher high. And again, you could sort of see right off the bat that market moves in impulse and corrective movements, right? So we have our impulsive move creating a higher high. We have our corrective movement putting in a new higher low. And we do not put in a new higher high until we make another impulsive move, wiping out this previous higher high. Because a lot of people may think that price pushing a little bit higher is already making a higher high. We do not create a new higher high until we wipe out this previous higher high. Then price puts in another impulsive move, another corrective move, and another impulsive move. And then we could see price is sort of consolidating, right? Not creating impulsive or corrective moves. We're sort of just bouncing between a support and resistance maybe. And then we could see the new impulsive move is now bearish nature. Now we create a new impulsive move towards the downside, and now we put in a potential lower high. Remember, we do not put in a new lower low until we wipe out this previous lower low. Right? This previous lower low needs to be wiped out before we actually put in a new lower low. So it's very important to actually make sure that you're identifying the previous structures so that you're actually making sure that you're breaking and retesting these zones. Any questions on that? Again, I don't want to go too in depth. If you want to get more of an idea of how I'm marking up the charts, how I'm analyzing market structure, anything like that, make sure to go to my YouTube channel. I have so many videos and so much content sort of going up at this in depth, and hopefully I'll be able to provide more value to you. Let's get into the nitty gritty, right? Support and resistance. Whose butt is that? Whose coolie is that? So support and resistance, supply and demand, whatever you want to call it, right? These are just major points on the chart that have significant rejection points around. So one of the most integral concepts, one of the most integral concepts of technical analysis are support and resistance levels. So we could see there's points on the chart where there's significant structures where price is constantly rejecting away from. So we have supply and demand, support and resistance, okay? There are areas in which price has rejected from in the past where therefore can reject again. Resistance rejects towards the downside while support rejects price towards the upside. Remember, these are zones, not precise points. This is very important for a lot of people because they love to put their zones as precise points in the market. These are general zones. So you want to make sure to not mark these sort of like lines like this. I always like to mark mine as zones. And again, if you're looking in my free trading setups, you've seen my support and resistance before. I almost don't want to go too in depth in this, just because I've said support and resistance probably a million times in my Discord server, especially if you're my premium members. Like, you should know support and resistance like the back of your hand. But I just put out a TikTok video validating support and resistance levels. So 3 pieces of criteria that you need to know to validate support and resistance levels. And I'll say it right now. The 3 pieces of criteria to validate said support and resistance levels. How many times have we rejected at the zone? The more times that we rejected at a support or resistance level, the more likely that we're going to reject at that level yet again. Okay, so if we've rejected off the level once or twice, sort of like this one right here, we can see at this level we've only rejected once off of this zone, and then we're pulling back to the zone and testing it yet again, which we could yet bounce towards the downside. But we could see a zone like this. You see how we bounced here multiple times, once, twice, and then we're coming here for a 3rd time, and then we're coming here again for a 4th time. Considering we bounced here 3-4 times previously, and now we're coming here for a 4th or 5th time, it's much more significant that price is going to bounce at this zone rather than this one, because we've only bounced here 1 previously, and we've bounced here 3 to 4 times previously. So how many times has price bounced at this zone? The more times that we've bounced at this zone, the more significant that zone will be in the future. So how many times have we bounced? How recent has trading taken place at the zone, right? This is very important, because if we've only bounced at this zone 2-3 years ago, and now we're coming to test the zone yet again, it's not as likely price is going to bounce at that zone if we bounced at this zone 2-3 weeks ago, right? So you want to make sure that you're trumping recent price action or recent market structure where price has recently rejected away from, rather than being significant of where price has actually rejected away from 2, 3, 4 years ago. Make sure you're paying attention to what happens way more recently than what happens 3-4 years ago. And then last but not least, clear intent with direction. And this is a very important one. Every single time we come to this support and resistance level, do we have a clear impulse towards the upside or towards the downside? If we have it to where it's swaying throughout the markets and then it treats it as support and resistance whenever it wants to, that's not as clear as a support resistance level that every time it comes to it, it goes towards the downside or towards the upside. That's showing us clear activity around that significant price point, and that's exactly what we want to see at support resistance levels. So that is support resistance. Then we're going to go into price action. Price action is very, very important. So another core component of technical analysis is price action. And this is basically just reading candlestick formations, right? Remember, I am monitoring the price action around significant daily horizontal levels. So I go back on the daily time frame and I identify support or resistance levels. And then I will scope down to the hourly time frame, and I will just identify this type of price action, candlestick formations, anything to give me a better idea of where price could potentially move in the future. And again, if you don't have a good idea of what price action is, make sure to go to my YouTube channel. I have a video literally outlining step-by-step process of how to effectively identify price action and how to utilize it in the market. So I usually am utilizing bearish engulfing, bullish engulfings. I use morning and evening doji stars, tweezer top, tweezer bottoms, head and shoulder patterns, 1, 2, 3 patterns, hanging man, inverted hammer. All of these are very good indications. And again, you want to be able to identify bearish price action around significant daily resistance levels, and you want to be able to identify bullish price action, this stuff right here, daily support zones. So it's very important. Larger the time frame, larger the price action. This is very important. So if you're analyzing price action on the daily 12-hour time frame, that price action is way more significant than if you're monitoring it on the 15-30-minute time frame. So get a good idea of how to monitor price action. Again, make sure you're going to my YouTube channel because it's a better idea of how to monitor it. So now that's it with technical analysis. Now we're going to dip into fundamental analysis, but I want to preface you, right? I don't go deep into fundamental analysis. I'm not a fundamental trader. I am purely a technical trader. And everyone says, Mike, you can't do that. You can't just trade technical. Well, I do it, right? I trade technical analysis. The only time that I'm looking at fundamental analysis, I'm looking at the economic calendar, and that's basically when to stay out of the markets, not when to go in. So now let's go into fundamental analysis, get a better idea of how we can utilize fundamental analysis. Fundamental analysis is a way to look at the markets by analyzing economic, social, and political forces that affect supply and demand on an asset. So this is more of the socioeconomic tensions, more of the headlines, more narratives, professional traders, financial institutions giving their narrative of where they think the markets are going to go. This involves studying economic trends and geopolitical events that may affect currency prices. In other words, it's the study of financial news and economic data. So now let's take a look at the economic drivers that drive the foreign exchange market. Number one is interest rates, right? Currencies rely on interest rates because these dictate the flow of global capital into and out of a country. Interest rates is the number 1, 2, 3, and 4 thing that moves the markets. If there's ever an interest rate decision for any currency, in my subjective opinion, I think it's better to stay out of the markets than to go into the markets, just because prices could go like crazy. Literally a week's worth of price movement could happen within 20 minutes if you have an interest rate decision on a certain currency. So you need to be very careful when interest rates happen. Inflation's another one. Measures the rate of change in prices of goods and services over a given period. Okay, so inflation is another big one. GDP, gross domestic product, represents the total monetary value of all final goods and services produced and sold on the market within a country during a period of time. And then employment data. The markets monitor employment because it is directly related to consumer spending. Naturally, people would be more willing to spend if they were employed and vice versa. So usually an interest rate hike happens when we have lower economic growth and slower inflation. But then an interest rate cut has higher economic growth and faster inflation. Again, I'm not going to go too in-depth in the economic side of things because your boy's a technical trader, and I highly recommend you adapting a technical approach. It's never been more practical to adapt a technical approach to trading, but it's very important to know the economic drivers and the market participants. Who participates in Forex? I always wondered this when I started trading. Like, who's trading in the markets? Is it just me? Is it other people? And this is it right here. At the top of the ladder, remember, we want to think of this as a ladder, right? In the top of the ladder are the major banks. The giant retail and central banks are at the top of the Forex market ladder and are the largest banks in the world, collectively known as the interbank market or flow monsters. Let me tell you something that will blow your mind. There are 5 to 6 banks that literally control over 60% of Forex transactions. 5 to 6 banks. It's very scary. You got JP Morgan, you got Citibank, you got HSBC, you have Goldman Sachs, I believe, and then a couple other that literally run over half of the transactions that happen in Forex. So just giving you a better idea of like who's actually the megadon of these markets, it's these big banks. It's the central banks and the huge retail banks, right? Then the next on the list, you have large commercial banks. So these are hedge funds, investment funds, certain corporations, and certain brokers that provide a lot of activity in the markets. But you got to remember, the central banks, they manipulate the market. Absolutely. If you don't think they are, you're absolutely naive. And a lot of people always like pontificate how you could get an edge in the market of like being able to get one over the central banks and stuff like that. I never think like that. I'm always just finding out how could I statistically have an edge in the market. I'm never thinking about the giant central banks and stuff like that. And then last, way near the bottom of the ladder is us, right? Our retail traders. Individual retail investors are the smallest fish in the Forex market as they just represent 5.5% of all Forex transactions. Could you imagine that? Even if you invest millions of dollars in Forex, you only account for a little over 5% of the transactions in the market. That just gives you a good idea of how large this market is. You could invest $2 million in the market tomorrow, and it barely would be a splash in the market. Just giving you a good idea of how huge this market is. And then we're going to go into quick resources. So this was sort of what I was saying before. These are different resources that you could utilize for fundamental data, economic data, and position size calculators. So number one, MyFXBook. MyFXBook is a great free platform for traders who want to calculate their position size calculator. So you need to know your position size, and that goes back to lot size. You need to know your lot size before every single trade that you place in the markets. And the only way that you could effectively calculate your lot size is by utilizing a position size calculator. That's it. MyFXBook is a phenomenal free website that allows you to just put in your stop loss, your account balance, how much you're willing to risk, and the currency pair that you're trading, and bam, it will give you the exact lot size that you need to be trading for that exact trade. It also gives you a free economic calendar, so you get a better idea of the high impact news, the medium impact news, and the low impact news. If you're like me, you'll just filter those high impact news events, and you'll just literally look at it on a week-to-week basis, and you'll say to yourself, okay, there's a lot of news going on for US dollar now. I'm going to stay out of it for today, right? I always stay out of currencies that have a lot of high impact news events for that day. Maybe you could do the same. Next, we have Forex Factory. This is more for my fundamental traders. This is way more for people who are focusing on fundamental data, what's happening in the news. This is not for technical traders. This is way more for fundamental data. I highly recommend, if you are going to be an economic fundamental trader, go to Forex Factory. It's like one of the best, in my subjective opinion, one of the best websites for fundamental traders. Not only there's a lot of websites and resources that are very good, but they're very biased, especially when you're reading news articles, you're reading reports. A lot of financial institutions may have some skin in the game, so they will actually portray their sentiment onto other traders so that it goes to their advantage, right? Forex Factory gets their data from a bunch of different resources, so you could literally hand select which one you're going to trust. Forex Factory is very good for fundamental data. And then last but not least, Stinu. This is a position size calculator, basically everything that MyFX book offers, just in an app, right? So if you're trading on your mobile app, which 90% of people do, Stinu is phenomenal. I think it may cost like $10 or $15 a year, but it's definitely well worth it if you're going to be a full-time trader. Let's keep it pushing. Now we're going to go into the psychological aspect of trading. This is very, very, very important. And I'm going to start off by saying, I could literally tell you everything about the psychological aspect of trading, but to be quite honest with you, the only way that you are truthfully going to learn the psychological aspect of trading is going through it, right? There's no better teacher than experience. And that's why the psychological aspect of trading, it's highly and largely dependent on experience and intuition and you going through instances. I could tell you don't revenge trade after you lost a trade and don't over leverage your account, and it could go in one ear and out the other, and you could still do it just because of your emotions, right? So that's why it's very important that a lot of this, not going to be taken with a grain of salt, but you need to understand that honestly, this is actually all very true, tried and true. Being able to implement it is a very difficult thing to do. So we're going to start off with the hardest part of trading. Beginners tend to make emotionally bad trading decisions that lead to blowing accounts. The Forex markets are open 24 hours a day, 5 days a week, which gives temptation. Social media has a very bad impact on traders. It often causes traders to develop FOMO, or fear of missing out, and lose trades. Percentage over profits. Whenever you are going off or monitoring your profits or losses, you want to make sure to monitor in percentages, not profits. Now we're going to go into a main key of the psychological aspect of trading, and that is backtesting your trading system. If you follow my lives, if you follow my content, if you follow my Discord, if you follow anything I do, you've probably heard me talk about backtesting in nausea. I want to go over this a little bit more in depth. Backtesting, something that can help you with your psychological aspect of trading dramatically. I don't even know if that's a word. Dramatically. Dramatically is backtesting. What is it? Backtesting is a method used to test how successful or unsuccessful a strategy is by using historical data. What are the benefits? It proves that your system works for you. That's like one of the main benefits. It will show you have winning or losing streaks. It proves that you will be profitable over time, and it gives you confidence in your taking trades and focusing on your system. Data is very powerful in trading. It reminds you that you're here for the long run. So whenever somebody asks me right off of the get, they ask me, how do you gain confidence in your trading system? The main thing that I tell them is I lean into statistical data. Emotions, hopes, feelings, those all lie. And the markets don't give a fuck about any of those. Statistical data, probability, and evidence, those don't lie. So that's why you need to lean way more into statistical data and probability than emotions and hopes. Most people, when they start trading the markets, they are just allowing emotions, hopes, and feelings to fuel their trading decisions. That is the number one thing that you need to avoid when you start trading the markets. You need to emotionally detach from your trading. But how do you do that? The only way to emotionally detach from your trading is to attach to something else. It's just true. You need to allocate that attachment to something else. And the best thing to attach to is statistical data. If I told you right now that a slot machine had a 67% chance of winning, would you pull that slot machine? And would you confidently pull that slot machine? Because I know I would. I know I would be pulling that slot machine till the cows came home, bro. No different with trading. If you knew that you were 67% accurate on a certain currency pair with your exact trading system, would you be more confident in placing a trade in that exact currency pair? Because I know I would. And that's where confidence is bred, right? Doing the same exact thing over and over and over and over again. And you see your trade play out over and over and over again. You simulate 400 to 600 trades in previous data, and you see your trades play out 60 to 70% of the time. Once you start trading the live market, it's just in a flow state, right? You're not even nervous. You have this statistical data proving that your system works. You've seen how the markets move. You've visually seen it with your own eyes, your trades playing out, right? That's why backtesting is the most valuable thing that any trader could utilize, because it allows you to actually sustainably trade the markets. And then your psychological plan. And this is just a quick psychological checklist, just making sure that we're staying consistent with the psychological aspect of trading. Only risk the amount that you are willing to lose. So you need to have a predetermined notion of what you're willing to risk in the markets. If you fail to plan, you plan to fail. 150%, and I truthfully believe that. As corny as it is, if you fail to plan, you 100% plan to fail in these markets. So make sure that you have a predeceived amount of risk that you're willing to risk on any given trade, whether it be 1%, 2%, 5%, 10%. I don't recommend those higher amounts. But if it's 1% to 2%, make sure that you pick an amount based on your comfortability of risk, and stick with that amount. Have a maximum amount of trades that you're willing to take at a time. Like for me, for example, I'm a hybrid between an intraday / swing trader. So this means that I'm not willing to take 3, 5, 7 trades at a given moment. The most trades that I will take is 2 to 3 trades at any given moment. I'm not going to be taking more at all. So make sure that you have that predeceived notion. Only be at your computer when you need to. This will stop you from over trading and forcing trades. This is very important. I always tell people, make sure you're waiting for candle closures. Of course, you need to utilize that top-down analysis approach where you start off maybe on the higher time frames and then you work your way down to the execution time frames. But make sure that you're only checking the charts when you need to check the charts. Because a lot of times, what your head will do, what your mind will do, is you'll be looking at a chart for 15, 20, 30 minutes, and then all of a sudden your brain starts to play tricks on you, thinking that you should be placing a trade when you actually shouldn't. You'll see things that, oh, wow, here's a support zone that I didn't see at first, but it's actually not really a support zone. It's a way like 15, 30-minute support zone, but you trade off of 4-hour daily zones, so you shouldn't even be trading off of that zone in the first place, but because you've been looking at the chart for 15, 20, 30 minutes, now your mind is playing tricks on you thinking that that's a support zone. You're way more likely to place bad trading decisions or make bad trading decisions if you're just looking at the charts 24/7. So make sure you're only focusing on the charts when you actually have to. You can even ask my premium members, and I believe Angel's in here. Thank you, Angel, for hopping in. I really do appreciate it. You can ask my premium members, like, if it wasn't for me actually talking out my analysis and stuff like that, I could literally go through 20, 30 pairs in 15 minutes. Like, I know if I have a trading setup within 5 to 10 seconds of opening up the chart. And I'm not saying that to brag. I'm saying that because you should be doing the same exact thing. If you're looking at a chart for 5, 10 minutes and you still don't know if you should be placing a trade or not, that basically means that you don't know your trading setup well enough. So make sure you're only focusing on the computer when you need to. Have a clear trading plan and entry plan and consistently look at it over. We went over that in the beginning of this presentation. Be aware of your emotional state after a win or a loss. Don't try and revenge trade or get greedy. This is very important. Make sure you are very emotionally aware. A lot of people undervalue or undermine the value of emotional intelligence in trading. You need to be so emotionally aware, and you need to soul search what works best for you with your tendencies and habits so that you could actually make the best trading decisions in the market. So if you notice that after a win, you're much more likely to place another trade, you should note that, because then it most likely means that you're going to place a bad trade that's going to take out all those profits. Inversely, if when you lose a trade, you don't want to look at the markets at all, you need to get better with that. That means you need to emotionally disconnect from those trades, because it most likely means that you're not looking back at those losers and taking lessons from them. And it most likely means that you're missing out on other opportunities that you could be capitalizing on. It's very important to be aware of your emotional state after a win or loss and realize that there's always another opportunity in the markets that you could capitalize on. I always laugh when people say that they beat themselves up after a loss or a missed opportunity. Literally, we're trading in the world's most liquid financial market, and we're crying over one missed opportunity. There's always another trading opportunity. So if you find yourself grieving or you find yourself dwelling over a missed or losing trade, you need to slap yourself in the face, look in the mirror, and say to yourself, I'm trading in the world's most liquid market. There's always another trading setup. It's very simple. Focus on your own trading and don't worry about other traders on social media. This is very important and controversial to what most people tell you. Most new traders, what they do is they point their finger at another profitable trader and they say to themselves, I'm going to trade that same trading system. The problem with that is that same trading system does not work with their tendencies and habits. It works with that profitable trader's tendencies and habits, but just because it works for them doesn't mean it's going to work for you. Like I said, there's hundreds and thousands of different ways to skin a cat in Forex. There just is. It's just about which one works best for you. That's why it's very important to become way more self-aware of what works best for you, not what works best for somebody else. So if somebody else's profits is making you FOMO into trades, but you're veering away from your own trading criteria, that most likely means that you're not well on your way to your own trading strategy. The whole point of starting Forex is actually making money on your own terms, not off of somebody else. I always laugh when people say that they're traders, but they just copy someone else's trading system or they copy someone else's trades. They're in a signals group and they're just placing trades in the market, but they consider themselves a trader. It's as if I consider myself an artist and I paint the same exact painting that someone else paints. I'm not an artist if I copy someone else's art. Just like you're not a trader if you copy someone else's trades. So be very aware of your own trading system and focus only on your process. And then last but not least, understand that you will not become rich from one trade and that you are here for the long term. It took me 18 months before I became profitable. That's right. It took me a year and a half before I became profitable in Forex and made 1 red cent. So the idea that you're going to make money within the first 2, 3, 4 weeks and you don't even know what a pip is, it's highly unlikely. This is not a get rich quick scheme. This is not one of those deals where you're going to make money in the next 2-3 weeks. Like this is small, consistent wins. Within the first 3 to 6 months, you may not make any money. Shit, you may lose money, right? But remember, this is not a short-term game. This is a very long-term game. I've been trading the foreign exchange market for 3 years now, and I'm just starting to see the rewards from it. So just get a good idea of sort of not only the timeline to profitability, but sort of what you could actually logically make from that account balance. Now we're going to go into the business aspect. So you need to treat trading like a business. Trading should be treated like a business. Keep a trading journal. If you ran a business, you would keep track of all your records, right? If you ran a business, you would have your profits, you would have your losses, you would have the resources, you would have everything that you need, your marketing. I like to look at trading like this. Your profit is all the money that you make from trades. Your loss are your expenses, right? Your expenses are considered your lost trades. And that's how you should be cutting the pie. Everyone always beats themselves up over a losing trade when it's just an expense. Losers are going to happen. You have those traders out there that are like 100% win rate. I've never lost a trade. They're scammers. The only thing guaranteed in these markets are losses. It's just about being able to win more than you could lose. Also, when running a business, you'll want to be able to control your risk. This is the same thing with trading. Make sure you are always calculating your position size, and I recommend Steno again. So let's go into trading journal. So there's a bunch of different things that you want to log with your trading journal, and I actually keep a live trading journal for my premium members, and I'll get into that in a second. But if you're not logging your trades, every single trade that you take, and you're not extracting some type of lesson from every single trade that you place in the markets, you're not progressing in your journey. It's as if I was throwing darts at a dartboard, but the room was completely dark, so I wouldn't even know where the darts were landing. If you throw a dart in a dark room, you won't know where the dart lands. So you can't even recalibrate to see if, okay, maybe I need to go more right with the dart. Maybe I need to go left. Maybe I need to go more center, right? It's the same thing with your trading journal. If you're seeing visibly that trades are winning, you want to analyze those trading setups so that you could do more of what works. And you want to analyze your losers way more than your winners so that you could do more of or do less of what doesn't work, right? What worked? What didn't? How could you made it better? Lesson. This is the main one right here. How could you have made it better? This is a main one. How could you have made it better? Take note on the day and pair because you could actually make correlations with the days of the week if you're profitable or not. AKA, for example, me trading on Sundays, I don't trade on Sundays because it is statistically proven that I have a net loss on Sundays than maybe Thursday or Wednesday. So I don't trade on Sundays. Analyze your stop and target levels. Is there a specific piece of price action or chart pattern that has a high win or percentage loss? So it's very important to look back at these trades and just make sure you do more of what works and do less of what doesn't. And this is really what's going to separate you from other people who are starting to trade the markets, because most people don't actually put more effort or put the more work that's needed of logging their trades and going through all of these different pieces of criteria. I actually utilize 3 different screenshots. So for my entry screenshots, I'm using the daily and 12-hour time frames, so just those higher time frames. And then I will utilize an execution time frame, which is usually the hour or 30-minute time frames, just to make sure that not only do I have the higher time frames, but I also do have the lower time frames in mind. And then I do have the exit screenshot as well. So you need to make sure to keep a trading journal. Now we're going to go into the last portion of the presentation, and that's the premium membership. So if we have any questions, concerns, comments before I actually dip into this, absolutely please ask away. But I'm about to dip into the premium membership right now. And this is basically just everything that I go into in depth with my premium members on a day-to-day basis. So it grants you 2 hourly long sessions per month, one-on-one calls, literally just chatting how I could help you in your journey. And we could literally just go very in depth of sort of where you're at contextually with your trading journey and how I could help you. I also provide you 4 fully comprehensive PDFs that outline your trading plan, how to utilize trading psychology, how to effectively backtest your trading system. And we literally go in depth of how to go through your trading system and make sure you have entry and exit criteria. Then this is the main one, live daily trading sessions, right? So every single day I will go live with my premium members, and this will basically just keep you up to date in the markets. It's an open Q&A. So maybe you want to have a better idea of how I'm marking up my charts, or you want me to go over certain currency pairs. This is the time to definitely do so. 4, you are provided with an exclusive community chat so you can engage and network with other traders in the premium membership. And basically, I have a lot of my premium members that are actually providing a lot of value than I am, right? That where they're placing in the markets, and they're sort of in a different point in their journey than I am. So it's very valuable for them to actually help others within the community. 5, my own trading ideas. So I provide my own trading signals. I don't like to call them trading signals because I don't do like TP1, TP2 or anything like that. It's just more or less me actually saying, okay, I'm placing a buy on NZD Canadian dollar, and then I will show my targets, my stop loss, and everything like that. But it's just to get a better idea. It's not for you to place the same exact trades. It's for you to get a better idea of why I'm placing the trades that I am. But you do get access to all of my trading ideas. And then last but not least, you get access to my live trading journal. This is very important. So I track every single trade that I call out in my premium community. And this just allows for so much more transparency, and it gives you a better idea of how you should be keeping your trading journal, right? So any one of my premium members at any given moment could click onto my live trading journal and see all of the trades that I placed this past year and literally look P&L, how much I've made every single month after month. It just allows not only to give them a better idea of my transparency, complete transparency, but gives them a better idea of how I'm actually logging my trades and journaling my trades. So these are all the things that I provide in my premium membership. But of course, I do have my free community, and I provide a lot of value, I think, with my free community. And this is $59 a month, and it is increasing. Right now, limited time only, we do have a week free trial. So the first week is completely free, risk-free. So literally the first week, I always tell people, especially on TikTok and anywhere else, the first week, you could literally join the premium membership, and then within the first week, get a very good idea, book a call, look at the PDFs, join a couple daily live trading sessions, look at my trading ideas, look at my trading journal, and then you could literally cancel the membership and you wouldn't have to pay a dime. So I'm not saying to do that. Hint, hint, maybe you should. But I'm letting you know that there's so much value in my premium membership. You could ask any one of my premium members that I guarantee you they do not regret making the decision. And of course, it is going up in the near future. Some traders are charging like $60 to $70 just for one Zoom lesson. And you get 2 hourly long sessions per month. One-on-one sessions per month. And then everything else, the live daily trading sessions, the PDFs, the community chat, my own trading ideas, and the live trading journal. So that wraps up the whole entire presentation. Do we have any questions, concerns, comments, anything that I didn't go over, anything that you guys would like addressed? If not, I really do appreciate all of you tuning in. It means the world to me. Make sure to stay tuned in that general chat with my trading setups and everything like that. And I would love to be able to provide some clarity on anything that you guys may have for me.